Now we're playing with an item that is traded on exchanges. It's a direct financial product, and it affects the markets, and there's knock-on effects, and there's leverage in all of these things. You mentioned in one tab the shadow leverage in the shadow banking system. This is the type of stuff that can cause another global financial crisis. And if it does, the people that don't have gold and silver are the ones that are going to get hurt, and the people that do have gold and silver are going to be benefiting tremendously.
Gold futures just hit $3,500 an ounce in New York futures trading, a new record. The spike comes as Washington considers imposing country-specific tariffs on the most widely traded gold bars in the U.S. And according to Mike Maloney, this move could shake the global economy far more than most people think. A statement from a White House official on an upcoming executive order followed a ruling posted by U.S. Customs and Border Protection, hinting that certain gold bullion bars could soon face import tariffs. The impact was immediate. Gold futures in New York surged to record levels, briefly touching $3,500 per troy ounce, trading at a premium over spot prices in London. That premium isn't unusual. Futures often run higher because buyers are locking in a delivery price that factors in costs like storage. Mike Maloney warns that the president's actions could have far-reaching consequences, even triggering something worse than the Great Depression. He points to the fragility of the global economy, the massive asset bubbles in U.S. markets, and the instability created by shifting tariffs. One rate today, a different rate tomorrow. Analysts say they're still waiting for clarity, but a U.S. tariff on gold deliveries would almost certainly hit Switzerland hardest. It's the world's top hub for gold refining and transit. This isn't the first time U.S. gold imports have jumped under unusual circumstances. In late 2023 and early 2024, there was a sudden surge in shipments, much of it from Switzerland, coinciding with President Trump's brief mention of auditing Fort Knox. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
My initial impressions are that this could end up upending a lot more than that. He's perturbating the global economy, perturbing it into a series of giant bubbles. To me, this could all end up worse than the Great Depression. There is that, there's a bell curve of probabilities. Maybe it won't happen, but the world economy is actually in a very delicate state right now, especially the bubbles in the US. And to wake up in the morning and the tariffs are this amount. The next morning, they're that amount. The next morning, it's where did all this come from? And where is Congress? That's what I want to know. Where is Congress? They are supposed to be doing this. It was Roosevelt that started all of these executive orders, really took advantage of it. But this is like a whole new level, the stuff that the president is doing now. And it doesn't seem to be, the impression that I get is that these things are on a whim. This is very, very dangerous. So go on with the presentation. But
yes.
This can affect, if it affects the commodities exchanges, that's one thing. If it affects the banking system, because, we're talking about gold being a tier 1 asset as a reserve. The one thing I want to point out is that it's seen as a strategic blow to shadow banking leverage. This is the kind of stuff that happened with collateralized debt obligations, and this is what triggered the global financial crisis back in 2008, the leverage that's in the system. And so perturbing the global economy with all of these, every morning, the tariffs seem to be different. And countries are scrambling, trying to figure out how they're going to continue, how their economies are going to be able to continue with these tariffs or without them, with us as a buyer. This is really doing something to and this could be a trigger because it's so monetary. Now we're talking about stuff that's traded on the commodities exchange, and we're talking about a central bank tier 1 asset. We were covering December, January, February, March in depth when that was happening. And, it was in February, I believe, that Trump started talking about auditing Fort Knox, or maybe it was January. but it was only for about 2 or 3 weeks, and then they stopped. And these huge spikes in imports of gold into the United States happened, and it's not just Switzerland. Switzerland is the red part, but look at how big the blue bars are as well. We just suddenly turned into this huge importer of gold for those 4 months. Now, I read some articles saying that blaming this on Trump's talk of tariffs, that they wanted to front run the tariffs. I don't think that was it at all. I think this is ending all of the rehypothecation of central bank gold and replacing what was actually missing because it was leased out. So they're unwinding leases, they're restocking Fort Knox, and an audit will be on the table in the future of Fort Knox. That probably will end up happening eventually, but they had to stop mentioning it. Who knows? But the stuff was probably missing because we do know that central banks lease gold. That is a fact.
Imagine shipping $61.5 billion worth of gold across the Atlantic, only to have nearly $24 billion slapped on top in new tariffs overnight. That's precisely what Switzerland is facing. In the 12 months to June, it sent $61.5 billion in gold to the U.S. Now, with Washington imposing a 39% tariff that took effect on Thursday, those same shipments could face an additional $24 billion in levies. According to the Financial Times, some Swiss refineries have already cut or paused shipments while they seek legal clarity on how these gold products are classified. Industry voices say the move is another blow to Swiss-US trade, making it harder to meet American demand for bullion. And Mike Maloney points out something bigger here: the way these tariffs are being made. Executive orders, the absence of congressional debate, and rapid reversals create uncertainty for the market. History tells us what that can mean. The Smoot-Hawley tariffs of 1930 throttled global trade after the 1929 crash and helped turn a recession into the Great Depression. Let's get back to the interview.
And some of the countries, like Australia, gold producer, they also produce the Perth Mint coins as well, though. Canada, gold producer, they also produce the Canadian maple leaves. Hong Kong, not a gold producer. I don't know if there's any refineries there or not. Mexico, gold producer. Singapore, not. South Africa, producer. When you look at some of these months, you see an awful lot that comes from Canada and other gold producing countries. I think that this total also includes ore, basically, the unwrought gold. So you're talking about doré bars that are, so move on to the next ones. And this is going by year. And this is Swiss gold imports divided by imports/exports with the United States. And so the imports to the United States and the imports from Switzerland, from the United States to Switzerland is on the top. Exports from Switzerland to the United States on the bottom, the middle, I mean. And then the net is on the bottom. And, if we are, the blue on the top is almost all unwrought gold. So what's going from the United States into Switzerland is mostly ore, or it is bars that don't meet certain requirements on the exchanges that have to be melted and recast. And that's one of Switzerland's main jobs as a gold hub. Yeah. So when you look at those other charts, there is a lot of gold coming from countries that actually mine gold, and it's passing through the United States on its way to Switzerland. This whole week, ramping up to this and this spike, there's probably no reason for it. I can't imagine putting a 39% tariff on companies that are, the gold is just passing through, basically. And those refineries have a profit margin of like 0.5% or less. It's just, they can't absorb 39%, which means that either gold has to spike by 39% suddenly here in the US, at least you can't have Swiss gold be different than everybody else's gold. This is just really tough to figure out. And this kind of back and forth. I keep on wondering, where is Congress in all of this? Why aren't they even commenting on all of these executive orders? In 1930, the Smoot-Hawley tariffs were one of the things that helped to take a recession and turn it into the Great Depression. It was passed by Congress, but this was, going back and forth and arguing and presenting different ideas and so on. And Congress did pass these tariffs that really slowed down the world economy and and we're doing this though. The bubble had already popped in 1929, and the tariffs came in 1930. The markets were on the way down. They weren't super overvalued. And this is all happening, this on again, off again. And now we're going to get a clarification sometime soon, don't exactly know when, that could really affect the global economy. And so now we're playing with an item that is traded on exchanges. It's a direct financial product, and it affects the markets, and there's knock-on effects, and there's leverage in all of these things. You mentioned in one tab the shadow leverage in the shadow banking system. This is the type of stuff that can cause another global financial crisis. And if it does, the people that don't have gold and silver are the ones that are going to get hurt, and the people that do have gold and silver are going to be benefiting tremendously.
Mike Maloney says the risk runs deeper than most people think. Gold isn't just a shiny metal. It's a financial instrument tied into layers of leverage across the global banking network, including the shadow banking world. Disrupt that flow, and you could light the fuse for a broader financial crisis. In such a scenario, those without physical gold or silver would be left vulnerable, while holders of precious metals could be in a significantly stronger position. That's why the market reacted with confusion this week. U.S. Customs and Border Protection said gold bars would be subject to duties. This significant change clashed with expectations under Trump's reciprocal tariffs plan, which includes a 39% duty on goods from Switzerland, one of the world's biggest gold exporters. The White House now says that's wrong. Officials plan an executive order reaffirming that gold bars are exempt. The confusion began when a Swiss gold refiner requested clarity and received a letter from U.S. authorities confirming that both 100-ounce and 1-kilogram gold bars would be subject to tariffs. Now, the forthcoming executive order aims to reverse that ruling and settle the matter once and for all. Tariff whiplash in one of the world's most liquid commodities is more than a policy footnote. It's a stress test for the plumbing of global finance. When the rules around a core settlement asset shift overnight, the impact doesn't stop at national borders. It filters through supply chains, trading desks, and leveraged positions that rely on predictable flows. How this latest reversal plays out may offer a glimpse of just how fragile the architecture of cross-border trade has become. Could abrupt changes in trade treatment for gold trigger a chain reaction that reshapes confidence in the broader financial system? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.